Down at the bottom is a little Q&A or Q&A button. If you want to ask a question or almost queue up your questions throughout the webinar, if something kind of pops into your mind and you want to get it out on the Q&A section, feel free to pull that up, type in your question, and at the end of this, we will go through all those questions and try to answer them for you. And just remember, this is meant to be interactive. So while we can't see you on the screen, we do want you to ask questions at the end so that we can hopefully answer as many of them as possible. So with that being said, let me turn it over to my colleague Eric, and he'll kind of tell you a little bit more about the history of Klaas and what to expect.
All right, thank you, CJ. I'm going to get this slideshow all set to go here. So one of the things we always like to do at the beginning of both our quarterly investment webinars and our Klaas University webinars is just give you kind of an update on where we are and kind of where we've come from. Obviously, a lot of our attendees and viewers are going to be clients of the firm, but there are some who are not. So just as a quick reminder, and it's kind of fun to watch this over time as we grow. At Klaas Financial, we have been in business about 48 years. And we primarily serve clients out of two offices, one in Madison, Wisconsin, and one outside of Rockford, Illinois. Those two locations, we have about 21 employees, and we serve just over 1,000 households. So those households are spread out all across the country. We are currently serving clients in 33 states, again, from our two offices in the state line area. And we manage about, just over $700 million on behalf of clients and employers. And as we kind of move through this process, people who've watched our webinars before, especially our Klaas U webinars, we generally have another outside professional on these with us. So we generally like to leverage what's called our Klaas Professional Network, which is a network of individuals who are experts in areas that perhaps we are not. So think attorneys, real estate professionals, accountants, for example, all the people that we need to bring in to help support our clients and kind of make sure we're taking care of their holistic financial picture. So if you want to learn kind of more about the Klaas Professional Network, you can go to our website, go to resources, click on Klaas Professional Network, and you'll see broken down by both our Madison or Wisconsin office and our Illinois office. You'll see kind of the professionals that we generally work with, that we've had really good experiences with. But because we're covering so many topics today, we're not just talking about, things your attorney would help you with or just things your accountant would help you with. We're talking about a lot of different things. So you have CJ and I here to kind of walk you through this process. But this is really meant to be an overview. So we cannot get into the nitty-gritty of every single one. Otherwise, as CJ was saying earlier, each one of our slides could be a whole webinar. So what we want to do today is give you an introduction, get you thinking about some of these things, and prompt you to be a little bit more proactive about your own planning. But this kind of leads me into what we're going to start with today, which is CJ is going to talk to us about some of the things we can do proactively to set up your estate plan to be effective for beneficiaries. And then thereafter, I will talk a little bit more about, how you respond to actually becoming a beneficiary and what you can do on the back end. So CJ, I'm going to hand it back over to you, and I will go ahead and let you get started.
Perfect. Yeah, so as Eric mentioned, we're going to be talking about proactive planning and then reactive planning. So the proactive would be you as owner of your own estate, kind of how do you handle beneficiary designations and wills, trust, powers of attorney, things like that, versus reactive when you come to find out that you are the beneficiary of an account or an estate. How would you go about handling that? I will be going through the first part, which is the proactive planning. Eric will be going through the reactive planning. Go ahead and go forward to the next one. So within the outline of proactive planning, here's the core topics we'll be covering. We're going to talk about wills, trusts, and powers of attorney. I'll then be discussing naming beneficiaries and strategic account ownership types. We'll go through how to create a cohesive plan between the estate and beneficiary designations. Talk about gifting versus charitable donations. That's actually kind of a freebie here for everybody. This is not specifically related to being a beneficiary, but it inevitably has a big impact on how you think about creating a cohesive plan. And then down at the bottom, I will be talking about tax considerations on various account types and property types. So beginning with wills, trusts, and powers of attorney. I will warn you as we go through this, we didn't want to have each page have a bunch of words on it. Instead, we wanted to kind of introduce a topic and then talk it through. So a will, trust, or power of attorney is commonly referred to as an estate plan or the core components of an estate plan. Now, any good estate planning lawyer will tell you your estate plan can consist of other things like living wills, also advanced directives, and marital property agreements. So there can be other component parts associated with a good estate plan. But when you hear estate plan, that is very commonly referring to these core documents, wills, trusts, and powers of attorney. So a will, very simply, is think of this as my advanced directive as it relates to what should happen to my stuff that does not have a beneficiary designation and my children, or I should really say minors that I am in charge of. Okay. And then who is going to be in charge, known as the executor, of settling my estate? Okay. Wills take power when you die. Trusts are active when you create them. Let me repeat that. Wills go into action when you die. Trusts go into action when you create them. The reason that we don't say it's one or the other is because we see people who use a will. They'll establish a good will with their spouse, and maybe their lawyer suggests that. But then within the will, there's what's called like a flip trust or a springing trust that says, hey, when I die, I want money to go into a trust for my minor child. So just because you have a will-based estate plan does not mean that you don't have a trust. It would just be the trust might be created upon death. Now, often our clients will say, well, I've heard there's this thing called probate, which is true. If you have a will, any asset that does not have a beneficiary designation will often go through probate. Doesn't have to, but it often does. So people will try to avoid probate by creating a revocable trust. So that could be a joint revocable trust, individual revocable trust, whatever it might be. We generally prefer to see our clients using trusts when they are looking for privacy or when they have properties in multiple states. Because remember, you have to open up probate in every state where you have property. So if you have property in multiple states, you might want to consider using a trust to try to avoid that legal proceeding. This is not to scare you from the probate process. Truth be told, here in the state of Wisconsin and even parts of Illinois, it's not terrible. You can get through it pretty easily, but there's court filing fees and required periods of time that have to pass, and a lot of people like to try to avoid that. The final thing when it comes to estate planning is powers of attorney. So a power of attorney is a document that says, while I am alive and incapacitated, who's going to act on my behalf? Now, there are some powers of attorney that take action immediately. So my power of attorney with my spouse actually says that she can act on my behalf without any qualifying event. Others would say, yeah, Eric just raised his eyebrows there. Others would say that, no, I have to be certified incapacitated by a doctor for my spouse to take action. So it depends on how you create the document. But the idea being that, hey, whether I'm incapacitated or I have just named another individual who has power to act on my behalf, powers of attorney only have power when you are alive. Once you die, a power of attorney is irrelevant. Then beneficiaries matter. Okay, now before we move on to the next slide, some of you are wondering, why are you talking about this? This is a beneficiary webinar. Because as you can imagine, certain assets must be passed on through a will or trust. Other assets have beneficiary designations. And so when you're thinking about this from the proactive planning standpoint, what most of you should realize is that you actually have two core estate plans very often. You will have whatever your beneficiary designations say on your life insurance, retirement accounts, transfer on death assets, and then you will have potentially separate instructions for whatever your will or trust says for anything that doesn't have beneficiary designations. So just remember, wills, trusts have certain assets. Beneficiaries of certain other accounts will go based on what you state in a beneficiary. Go ahead and move forward to the next slide, Eric. So, of course, we talked about what happens to assets that don't have a beneficiary designation, or think of minor children that you would want to care for and name guardians through an estate plan. Now we start to think about naming beneficiaries. And again, this is on the proactive planning side. So in naming beneficiaries, and actually go back to the last one there real quickly, Eric. In naming beneficiaries, you want to be thinking about often it's spouses primary, children as potentially equal contingents. But within that, it's this idea of, hey, when I pass away, whatever account I have, think 401k, think an IRA, think a life insurance policy. Upon my death, once somebody has a death certificate, this happens pretty quickly. Eric and I have the displeasure of going through this quite often with people. Just earlier today, I had a widow in here filling out paperwork from no more than a week or two ago, death of a spouse. And so when you have a death certificate and you kind of work through beneficiary processes, it happens pretty quickly. And those beneficiary designations are critical. So actually this phrase that we use, which is your beneficiary designations trump or supersede anything that your estate plan says. Because one misnomer we hear is, well, don't worry, CJ, I just redid my will, so I'm good. And we go, your will may say what's happening to your house and your bank accounts, but you didn't change any of your beneficiary designations. And until you do that, nothing has changed with the assets that have a beneficiary designation. So remember this. If there's one thing you take away from here today, remember, there are actually two parts to your cohesive planning that you need to do. There is assets that do not have a beneficiary, and then there are assets that do. And the assets that do, they do not change until you change those designations. Also within this, we talk about strategic account ownership, which gets into owning things jointly. A common ownership type that Eric and I see is joint tenants with rights of survivorship in like a marriage, because you say, hey, when I die, I want my spouse to immediately have ownership over that. And so dealing with different ownership structures when you are capable is another way of strategically making it simplified if something should happen to you.
Yeah, I'm glad you hit that topic, CJ, of just this idea of, oh, well, I updated my will. Don't worry. I don't have to worry about any of these accounts. To your point, the beneficiary designation is going to be the thing that rules in that case, and that's not necessarily a bad thing, right? When something has a beneficiary designation attached to it, in most cases, that means it's avoiding probate, right? We're completely avoiding that kind of, I guess you could say scary topic. But we're avoiding that administrative proceeding. So the beneficiary designation is a really powerful tool in this.
Yes, absolutely. So we've talked about estate planning. We've talked about beneficiary designations. Now we need to talk about unifying those. So this is very critical. First things first, you need to understand that there are technically two different plans playing out in your overall estate plan, beneficiary driven, will and trust driven. But then secondarily, you need to build a unified plan. Now, a good estate planning lawyer, of which we work with many, by the way, as Eric said, go to our website under resources, Klaas Professional Network. You'll see it state by state and see a lot of good estate planning lawyers that we work with. But a good lawyer will create cohesion amongst this. Now, a mistake would be to assume that cohesion means uniformity. Let me repeat that. A mistake would be assuming that cohesion means uniformity. And what I mean by that is it could make a lot of sense for you to, as an example, take all of your pre-tax retirement accounts and make that the money that goes to charities, Whereas the money that flows through your trust or will, and maybe some other taxable bank accounts, is what goes to children or family members. We're going to get into this more later when it has to do with like taxability of different account types. But that could make a lot of sense because of tax factors that Eric's going to talk about when it comes to receiving assets. Okay. But what you need to understand is that building cohesion amongst what do the beneficiaries say, what is my overall structure of my estate plan, and have I named everything appropriately inside of these so that my wishes get carried out in the most tax efficient manner upon my death. It sounds complicated, and for a lot of people, they think to themselves, oh, I could never do this. Well, good news is there's very good lawyers that deal with this all day, every day. I've even heard things like, well, but CJ, what about if it's a second or third marriage? Or what about if I have a child who, has maybe a gambling problem or drug addiction? That's just insurmountable. And my comment to you would be, you're not the first person to go through a second or third marriage. You're not the first person to deal with a child with a gambling addiction. You're not the first person who maybe has a second spouse that you want to care for, who also wants to give assets to children when you die, right? So like every situation that you can think of that you think is super unique to you probably isn't that unique to an estate planning lawyer, and they would really be able to help you sort through that. Now, before we move on from this, I just want to hit one really important topic. The number one reason that Eric and I hear that people don't get their estate planning done, which then of course works in unison with beneficiary designations, is because they say to us, it's just too big of decisions and I don't know what the right decision is to make, right? Too much to consider. And I went this way, and I just put it all to bed. Listen, everybody, if you don't create your own plan, the good news is the state that you live in has created one for you. It's called dying in intestacy. It is dying without a plan. And here's the good news is they have a plan for you. The bad news is it doesn't say what you want it to say. Okay? Even your worst plan is better than relying on the state. Let me repeat that. Even your worst plan is better than relying on the default for the state. So please don't be one of those people who says, I knew and I kind of moved towards it, but I couldn't ever decide, and guardianship was really hard. And listen, these are very challenging things to figure out. Do your best, come up with what you think is right for now. You can always modify it as you move forward, and just know that it will never be perfect.
Yeah, I'll add the other thing I hear a lot is, well, I don't need an estate plan because everything's really simple. It's easy. That's for people who have way more resources than I do, way more assets, whatever it might be. But the quickest way to make a very simple estate complicated is to do no planning around it, right? Because even if you don't feel like, gosh, I'm not, I don't have all of these millions of dollars that somebody that needs an estate plan has, you still have decisions that need to be made around your family. And as we talk about later in the reactive planning side of things, your beneficiaries will thank you for just taking those few steps on the front end to make things a lot easier later on.
Absolutely. So we're going to take a quick aside, and it's going to feel like, again, a topic that doesn't apply to kind of a webinar on beneficiaries, but it does, because often what we hear is, well, I heard I can just kind of like gift it all away. Well, we need to talk about gifting versus charitable donations, because this plays into a cohesive financial plan and estate plan. So gifting to, we're going to say individuals, think for simplicity, children and grandchildren. Gifting, you can do that. And the good news is you have a lifetime exemption amount of how much you can gift. That's about $12 million under current law. This is what you can gift during or after life. And think of it as like a certificate of $12 million off to the side. But even beyond that, you have an $18,000 per year per person exemption that doesn't even have to use up your certificate of $12 million. So I have three children. They're actually pictured right back here. I could give $18,000 to each one of those children per year and not even reduce my lifetime exemption amount, which is pretty great. I don't pay taxes when I give them that money, and they don't pay taxes when they receive it. It is just a tax-free gift. Now, interestingly enough, I have to use post-tax money. I can't pull money out of my retirement account. Rabbit trail we're not going to go down today. But the idea being I have paid income taxes on the money I have sitting in my bank account. I then can give that money to my children. They don't have to pay any tax on it. And as long as it's below 18,000 a year, I don't reduce my certificate, my lifetime exemption amount. If I go over that limit, I start reducing that certificate, but it's $12 million. I've got a big certificate to deduct from. Now, again, another rabbit trail is, but we heard that that number is coming down. It is. There's some sunsetting happening of different estate tax exemption amounts, but that is too complicated for our discussion today. Now, shifting from gifting to individuals and family members, there are charitable donations. Okay, charitable donations to 501c3 registered public charities or donor advised funds. I want to be really clear. Your children and grandchildren are not charities. As much as, by the way, they may feel that way. Again, I have three of them. I often feel like I should get a deduction for giving all this money to them. But the idea being when you give money, you're dealing with non-charitable entities. So that $18,000 annual amount and the lifetime exemption amount, that's kind of the rules that apply over there. When you're giving to charities, those are charitable entities that could benefit you on your taxes. But where charitable donations get a little bit complex is they're part of an itemized deduction schedule as part of your federal tax or your tax return. That itemization includes like four core categories. There can be medical expenses over 7.5% of your AGI. There can be what are called SALT, state and local income tax deductions that max out at 10 grand. There can be interest on your mortgage if you have a primary residence mortgage. And then finally, the fourth component of your Schedule A itemized deductions would be your charitable contributions. If those itemized deductions don't stack up to be more than your standard deduction amount, which I should have written this number down, but I think it's around 27, 28,000 if you're under the age of 50, somewhere in that neighborhood. And that's actually for married couple. So you have to look this up if you want as an individual or if you're over the age of 50. You have to look up the exact amounts, but let's just keep it simple and call it $30,000. If those itemizations don't stack up to be more than $30,000, then it's as though you get no tax benefit at all. Okay, so again, itemization has to stack up to exceed before you get any tax benefit. It has to exceed the standard deduction. Again, there's changes happening come 2026, but just think of these charitable donations as things that could benefit you on your taxes, but you've got to have enough of them to exceed the standard. Eric, any thoughts on this that you want to share?
No, you're right on the money with those numbers though. Single taxpayers, their standard deduction is 14,600 this year. And then for married filing jointly, we're looking at 29,200. So that is the amount that you can that you need to exceed to CJ's point. Otherwise, you're basically getting no credit for the other than the joy of giving and supporting something that's important to you on your taxes. You are not getting any sort of benefit. But I think the one thing I would go back to is as we're talking about, these potential changes to the amount you are allowed to give in your life, there are a lot of things, even with those numbers changing and the number coming down, so we're talking about around $6 million rather than 12. Remember, we have that $18,000 per year that's just free, right? And by the way, you and your spouse, if you're married, can each give $18,000. So if you have three children, you can give them each $36,000 this year, and it doesn't count against your lifetime gift at all. So as much as that can get noisy in terms of like, oh, how much is the total amount that I can give away? There's a lot of ways to go about addressing that. But again, you have to be thinking about it ahead of time, and you need to be proactively planning. Which we talk to a lot of our retirees, especially about this. Once you've been in retirement for, I don't know, 8 to 10 years, kind of get an idea of how much you know, how the whole process works, you start to see that, you're maybe not going to spend all the money that you've saved. That's where we start to get people thinking about this. Do you want to be a little bit more supportive of a charitable organization, or do you want to help your kids, right? That's a lot of fun to see your kids enjoy the gifts that you give to them while you're still here. So this is again just part of that proactive planning process.
So think of gifting again to individuals, family members during and after life. During life, we have those 18,000 or lifetime exemption amount, can't generally give out of retirement accounts or other tax qualified assets like annuities. So it has to be like post-tax assets typically. That's during. Afterlife on the gifting side is death benefits, settling estates, which is what Eric's going to be talking about here in a little bit on the reactive planning side. When we shift over to the charitable donation side, same thing. You can do charitable donations that could potentially benefit you on your taxes in the year in which you give them while you are living. Now, why would I, from a tax standpoint, give to a charity? Well, to hopefully exceed the standard deduction and to actually benefit the charity and get a little bit of tax benefit for doing so. After life, I'm deceased. I don't get a tax benefit, but the overall of my estate does when I give to a charity, especially if I give a pre-tax retirement account to a charity. More to come on this when Eric gets into his section, but you think about that pre-tax retirement account going to my children, they probably have some tax liability, whereas pre-tax retirement account going to charities, one of the things that's brilliant about charities is they don't pay income taxes. So this gets into the kind of the creative side of how you want to think about structuring your overall estate plan to benefit during life and after life. All right, go ahead and go to the next slide. So I am going to cover some tax considerations on various account types, but again, think of this from the proactive planning standpoint. So this is me thinking of planning for myself. So this could benefit me in the year that I'm here or in the future. So pre-tax retirement accounts like IRAs, 401ks, and 403bs offer me present deductions. Okay, and this is not a gift to a charity, so this is not part of an itemized deduction here, everybody. If I am eligible to make a contribution into one of these accounts, it immediately brings down my taxable income. I have to be eligible. Not going to go down that rabbit trail today, but you have to be eligible. But assuming you're eligible, immediately reduces your top line marginal income, huge tax benefit. I then get tax deferred growth. So I didn't pay tax on the front end. I do not pay tax along the way, known as compound growth. And then in the future, when I hit retirement or age 73 or 75, whichever comes sooner, I then have to start pulling money out and paying income taxes in the future. Okay, that's a pre-tax retirement account. The next account on our list there is a Roth retirement account. There could be Roth IRA, Roth 401k. Again, I have to be eligible. But assuming I am eligible, I do not get a tax break for the contributions that go in. So it is a post-tax contribution. But that Roth account does the same deferral that my pre-tax account did. So it's post-tax contribution with tax-free growth. And as long as I leave the money in there, that growth in there till 59 and a half, I can pull my original dollars plus all the growth out with no tax. Now, a common mistake at this point would be for people to go, oh, that sounds better than pre-tax. Actually, that's wrong. We could run the math equations for you and the regression analysis and show you this. And actually, neither one is better or worse. I mean, if I knew the future, I could tell you which one would be better or worse, but I don't know the future. So the idea of this is say, no, neither one is better or worse. They have different benefits that depending upon where you're at in your income could benefit you more. So work with a good financial advisor and they can help you determine how much should be pre-tax and how much should be Roth. The third type of account that we see are taxable accounts, often referred to as brokerage accounts. Truth be told, taxable money is just money that you've already paid tax on, that you do not put into a tax preferred account, that then just as it grows, you pay some sort of tax on. Inside of a brokerage account, you can earn dividends, interest, and capital gains. They all have slightly different tax elements to them, but just think of it as generally, I pay tax along the way. Okay, that's what a taxable account would be. Now, there can be certain weird circumstances where like I bought a stock and it exploded and there's no dividends, but it went from 100,000 to 200,000. And you say, CJ, I haven't paid tax along the way at all. That's true. That would be a capital gain that you have yet to pay tax on. And Eric, if I sell it, by the way, I do pay capital gains taxes, but Eric's going to talk about how that gets treated upon death if you're a beneficiary. Okay. So money in your bank, by the way, that's taxable money, right? Technically speaking, money that goes into your home, that's post-tax taxable money. Okay. The next type is annuities. So annuities, think of annuities as almost a hybrid between taxable and retirement. Okay, so stick with me here. Assuming this is not an IRA annuity, which is a whole different beast we're not going to talk about today. Assuming this is just an after-tax normal annuity, whether it be variable, fixed, or indexed annuity. When I put money into that annuity, it's post-tax money. Okay? Again, assuming this is not an IRA annuity. I put the money in post-tax. The growth on that annuity is actually tax deferred, almost like a pre-tax 401k or IRA. So my corpus, post-tax, my growth tax deferred. And then when I go to pull money out of that annuity, by the way, generally has to be after age 59 and a half, kind of weird. It's like a hybrid between taxable and retirement. When I go to pull that money out, assuming it's not part of me annuitizing the contract, then it's called LIFO, last in, first out. So I have to pull out earnings first before I can get back to my corpus that is post-tax. Okay. So think of annuities as these kind of weird mishmash of has some features of taxable money, has some features of tax deferred growth like a retirement account, and then some features of a retirement account around age restrictions. I guess let me just leave you with this. Warning, warning, warning. Be cautious with annuities. They can be great and they can serve wonderful purposes for continuity and guarantees and income, but you really have to know what you're doing on a tax from a tax realm. And then finally, the type of account I want you to be aware of is life insurance death benefit proceeds. So here's the key. Life insurance death benefit proceeds under the vast majority of circumstances is going to be income tax free to your beneficiaries. Let me repeat that. I buy a life insurance policy on myself, owned by myself or my spouse. I die. Those dollars, when they go to my beneficiaries, income tax free. They are considered part of my estate. Remember, I told you there's a $12 million certificate that you can give during or after life. So those death benefits do count towards that total $12 million exemption amount in my example. But from an income tax standpoint, there's no income tax liability. If there was any tax, it would be called an estate tax if your estate was over $12 million. Now, for our friends who are listening down in our Illinois market, you also have a state estate tax that starts at $4 million. I'm laughing because I'm a native of Illinois, and there's been a lot of things changing for you all in Illinois. Not only did your state income tax go up, but there's a state estate tax that has come and gone. Truth be told, we have things changing here in Wisconsin as well. It's part of the reason why you need to be working with a good financial advisor, because as these things shift, you need to be aware of some decisions you might have to make. But I'm getting too deep into the weeds. Life insurance, generally income tax free to your beneficiaries upon death. My final section is just going to be a quick high level, and this is before I turn it over to Eric to kind of take us across the finish line as it relates to receiving dollars. But the final slide on proactive planning would be tax considerations on various property types. We talked about account types, but now let's talk about property types. There's things called real property, which is often the short slang for real property is real estate, but it's the land plus any permanent structures that are on that land. Okay. So real property, when I buy, say, primary residence, I use post-tax dollars to do so, and then I do not pay tax under current law. I do not pay tax on any of that growth. There's even some exemptions I get for primary residence and other things like that. But real property has this kind of, or real estate has kind of this interesting beast all around it. We're not going to dig into rental real estate because boy, oh boy, we could do a 4-hour long webinar on that topic alone. But for today, just think of it in terms of my kind of home and primary residence. Post-tax money to purchase, under most circumstances, I'm not going to pay any tax. When I sell it or die, under most circumstances, no tax is due by my estate. Personal property, think of this as vehicle, jewelry, the computer sitting here. Actually, that's owned by Klaas Financial, but you get the idea. Personal property, clothing, TVs, everything like that. I use post-tax dollars to purchase it. When it goes to my children and my estate, no tax due upon those assets typically, unless they stack up to make it more than that total exemption amount we discussed. Okay, I feel like I'm rambling. Eric, anything I've missed in the proactive planning that you can think of?
I don't think so. I think a lot of these last pieces will make a lot more sense here shortly when we talk about kind of how these are received by beneficiaries and how they pay taxes on them. Because a lot of what we're going to talk about in that section will really feed what we want to be doing on the front end. So let's talk a little bit about that. So this section we're calling reactive planning. And this picture here, I'm now realizing this guy looks pretty stressed. But generally, when we have people coming to us saying, maybe they had a parent pass away, an aunt or an uncle, or somebody who's leaving them assets, surprisingly, in many cases, separate from, the personal feelings of loss, I think, CJ, you can disagree with me here, but I find people are often quite stressed by the not just the process of inheriting the dollars, but what it's going to mean for them. I've heard a million times, oh my gosh, this is going to blow up my taxes. I'm going to be, I'm going to lose all of this to taxes, and I don't even want to approach this. And so what we're going to talk about here, initially at least, is going to be really related to who pays taxes on these things, how much tax do you pay on them, because in many cases, and I'm oversimplifying, but in many cases, there's much less tax impact to the beneficiary than they expect. So we're going to kind of go through those same asset types CJ was just talking about, but just talk about what that looks like for the beneficiary who is inheriting them. So we're a little out of order here, but let's start with those taxable investment accounts. So remember, this is your bank account, your investment account, anything that is not in a tax preferred retirement account, or an annuity. Now, in most cases, with a taxable investment account, probably owns stocks, mutual funds, exchange traded funds, those types of investments. These are a wonderful thing for a beneficiary to inherit because they get something called a step up in basis. Okay, so essentially what that means is the IRS allows the individual who inherits the dollars, not receives them as a gift, okay, inherits the dollars or the stocks to basically wipe out any capital gain that may have been due there. So CJ was talking earlier about, okay, you buy a stock and let's use easy numbers. You buy a stock for $100. It's then years later worth $200 a share. You should theoretically have a $100 capital gain to pay tax on when that is sold. But if it goes to the beneficiary, at which point it is worth $200 a share, and then the beneficiary sells it the next day, the IRS views it as they purchased it for $200 and they sold it for $200. Okay, so what we are just, that is a huge tool for beneficiaries. So when your beneficiary is often an individual and not like a charitable organization, taxable assets are a great asset to leave to them. Because remember, we're talking about this idea of cohesion between your beneficiaries and your estate plan, but not necessarily that they match, right? So your will may not look exactly like your beneficiary designations because certain assets are more beneficial to leave to different types of beneficiaries. Let's talk about then non-qualified annuities. So CJ touched on this earlier, and I think the reason that, because I have the same feeling as him, as these can be powerful from a tax perspective, but they can also kind of backfire in the way that they are great tax deferral vehicles for the account owner. They are less than ideal to inherit from the beneficiary's perspective. Now I know what you're saying. Hey, I left them money. They can pay the taxes that are due on it. Totally agree. But if we're talking about kind of maximizing and having the least amount go to Uncle Sam and actually more going to your beneficiaries, non-qualified annuities are not an awesome tool for that. The reason being is, as CJ said, you put after-tax dollars in there, right? They grow over time and well, hopefully grow over time, and you pay no tax on that growth, okay? But then when you take the money out, as CJ said earlier, if you draw it out as a lump sum, you're going to be paying taxes on the growth first. If a beneficiary inherits an annuity, there is no step up in basis like there is for a taxable investment account. So we're not eliminating any of that growth. And even more, when dollars come out, when any taxable dollars that come out of an annuity are taxable as ordinary income, not capital gains. Okay. Capital gains receive preferential tax treatment, lower generally than your marginal income tax bracket, but a non-qualified annuity is receiving neither the step up in basis nor the preferential capital gains tax treatment. So again, no one's going to feel bad for a beneficiary inheriting an annuity, but it is probably one of the least efficient tools for transferring wealth. Now, there is one other thing related to an annuity that, as beneficiaries, you want to be aware of. Non-qualified annuities have something called a stretch provision. Okay. Now, this is probably the most tax efficient way for a beneficiary to get assets out of an annuity in many cases. So essentially, what you are doing is you are required to take a minimum amount out each year, but you're allowed to stretch it over your lifetime, right? So you're not required to draw it all out within 5 years or 10 years. You can take it out over time, thus spreading out your tax liability. You can also do something called annuitize the annuity, right? So actually turn over the balance that you have in there to the insurance company in exchange for a payment for the remainder of your life or a minimum number of years, whatever it might be. This is actually attractive from a beneficiary's perspective if they are in retirement themselves and they need income or really any beneficiary that needs income, because as you draw those dollars out, you get credit for the amount that was in there to start with, right? So we said earlier, when you just take a lump sum out, you have to pay tax because it's all gain coming out initially. With an annuity, some of it is taxed, some of it is not because you're receiving a return of the premium that went in. So again, these are really complicated, and we don't expect you to make big decisions based on these, but in general, these are not great tools for transferring wealth.
Just to reiterate what Eric said there on non-qualified annuities through the lens of, again, reactive planning. So you find out you're a beneficiary of a non-qualified annuity. Hear what he said loud and clear. There's kind of like three options. Take a lump sum, and then you're just going to pay income tax all as ordinary income on whatever portion of your inherited annuity was gain. Not great, right? Option two is take advantage of the stretch provision, assuming it has not already been stretched, by the way. So you can only stretch once. Take advantage of the stretch provision over your lifetime, pay a minimum distribution based on what's called a single life expectancy table. And that's good because it allows for the continued deferral potentially, and you only pay tax on a little bit as it comes out. Or option number three, as he just said, is to actually annuitize it, which there's something called an exclusion ratio. Again, a lot of rabbit trails we could run down that just actually think of it as it pro rata disperses every income payment between basis and gain. So you get an exclusion ratio to kind of even out that tax impact over time. So those are your three options. What we see most commonly is that people just go, I don't know. I've got some brokerage account money. There's a house that mom and dad had. There's a retirement account. And then there's this annuity thing. I don't know. Just send me a check, right? Fill out the claims paperwork and boom. Unfortunately, as Eric just said, these are not the best vehicles to inherit because they're so filled with potential tax problems that people don't get or understand. So I guess in a roundabout way, what Eric and I are saying is if you inherit a non-qualified annuity, talk to your accountant or financial
Yeah.
advisor. You need to slow down and look at that.
Yep. And I think as the step up in basis that taxable investment accounts get make them a much more attractive option, not only from the beneficiary standpoint, but in many cases from the account owner standpoint as well, because there's easy access to the money without, restrictions on when they can access it, how much can come out, that sort of thing. Um, but let's talk about retirement accounts. Okay, we've been talking about taxable accounts and non-qualified annuities. Let's talk about qualified retirement accounts. So pre-tax or tax-deferred accounts. Okay, CJ was talking about these earlier. They're your 401ks, IRAs, 403bs. These types of accounts are taxes have never been paid on the dollars that are in there, right? You've made a contribution, deducted it from your income, and then it is growing tax deferred. When this is actually inherited by a beneficiary, we're going to make a distinction here after January 1st, 2020. Okay, so there was a huge law change that came into effect called the Secure Act. It's passed at the end of 2019. It took effect as of the beginning of 2020. Made huge changes to the ways that IRAs, or not IRAs, qualified retirement accounts are treated when they are inherited. So post 2020, a spousal beneficiary still has the option to treat the account as their own. So it's about as simple as it comes. Spouse one passes away, spouse two is the beneficiary. Spouse two basically can transfer the funds into their own retirement account and treat it as their own, right? They have to take required minimum distributions later on, but there's a lot of flexibility around, what they can do with those accounts. Non-spousal beneficiaries have fewer options as it relates to this. Historically, pre-2020, there was an option to do something similar to the non-qualified annuity stretch, where you were able to stretch the distributions of this over your lifetime. But post-2020, it's now basically the longest that you can take to draw out those assets is 10 years from the date of death. Okay. So when a non-spousal beneficiary inherits a pre-tax retirement account, any dollars that come out are taxable as ordinary income. They are required to take a minimum distribution each of the first 9 years post-death, right? Because you have to have everything out in 10 years, but also you have to take at least a little bit each year. So you could take a small amount for 9 years and then have a huge amount to draw out in the 10th year. You can take out 10% a year, right? To kind of spread it out. Remember, these are taxable dollars that are coming out. So this is going to involve a lot of planning with your accountant and your financial advisor, because let's say you're inheriting dollars and you are 5 years from retirement. You are in your highest income earning years. You don't necessarily want to take money out and realize it when you're in a higher tax bracket. You could say, all right, I'm just going to take the smallest amount out that I can, that minimum distribution for the first 5 years. And then I'm going to retire. My income's going to go down quite a bit. I'm going to need retirement income anyway. Let's actually put off taking most of the distributions until I've retired. And then I have 5 years to get the remaining dollars out, right? So as we've moved through this process and we've kind of gotten used to the new rules post Secure Act, what we're noticing is, number one, there was a lot of confusion on the front end in terms of like when dollars had to come out. Most of that has been clarified at this point, but it really created a situation where pre-tax dollars that were inherited, they have more potential to cause tax problems for the beneficiaries. Historically, you could take it out over your lifetime. It was a really small distribution amount. Most people ended up exceeding that at some point and just spending the dollars down. But we have to be more cognizant, because there are just not as many options now. But CJ mentioned earlier, one last point on the pre-tax accounts. This is a great place to list a charity as a beneficiary. Because what did CJ say earlier? Charities don't pay income taxes. They can also receive taxable assets at death or even during life under certain circumstances, tax free, right? So rather than listing a charity as a beneficiary of your taxable investment account that's going to receive a step up in basis at retirement and basically eliminate any capital gain required, rather than doing that, why not leave the tax deferred investment account, which would have taxes due, to the charity to avoid any taxation there, and then leave your taxable investment account to human beneficiaries who would have to pay taxes.
So everybody, first off, Eric, great job explaining this because this is complex stuff, everybody. The whole change from pre-Secure Act, so pre-2020 to now from the stretch over a lifetime versus the 10-year stretch that Eric just referenced. Listen, we're in the business, and I would say this whether I was in the business or not. You pretty much now need to be working with a good accountant or financial advisor if you're inheriting retirement accounts. The number of circumstances that could impact the decisions that you make, whether it be dollar amount, your current working income, whether the grantor reached something called an RBD, a required beginning date, whether RMDs have to be pulled out or not, if you're a spouse or a non-spouse. There's so many, think of it as like a lexicon of decisions. There's so many things that have to be decided that there's just pitfalls everywhere. So this is not us trying to force you into working with an advisor. I mean that sincerely. It's just more, I would never do it on my own if I wasn't in the business. And I will admit to you, I've been doing this for about 20 years. I still, every time this occurs, have to really slow down and run it through a filter.
Yeah.
So, not for the faint of heart. Unfortunately, dealing with inheriting retirement accounts has gotten significantly more complex over the years.
Yeah. Yeah, and the last one here, Roth retirement accounts, they were largely impacted just like pre-tax retirement accounts were by the Secure Act. Um, but remember, dollars that you're taking out of those accounts that you're inheriting, there is no tax liability related to them. Essentially, what you're losing by needing to draw it out is the continued tax-free growth, right? But the for Roth qualified accounts, when you inherit them, they have the same 10-year timeline. You have to have every dollar out by 10 years after the date of death. However, they do not have a required minimum distribution. Okay, so that little bit you'd have to take each year does not apply to these types of accounts. And if we think about it, it makes sense, right? The IRS isn't going to be receiving any sort of tax revenue from the distribution. So they're saying, hey, as long as you have it out in 10 years, no harm, no foul. And we just want to make sure these dollars don't continue to accumulate for another person's entire life, right? But that's, as we look at kind of the what I'll call like the non-real assets, these are kind of the big ones that we see. But as we kind of finish the discussion of taxation, I wanted to come back to two that CJ touched on earlier. Life insurance proceeds, again, as a beneficiary, in most cases, life insurance proceeds are paid out tax-free to you as the beneficiary. They are also, well, I'm not going to get into the complications of who owns the policy and when it counts against lifetime gifting credit, but life insurance proceeds generally are very advantageous to the beneficiary. Lastly, real property. So houses, basically anything that doesn't go into an account isn't a financial asset, but it is a tangible thing in the world. In most cases, again, real property that is owned personally receives that step up in basis. One thing that I have seen as an advisor more than once, and this comes back to something that really goes in the proactive planning part, but people will, especially as they get older, they say, I want to make things easier for my kids. So I'm going to add them on as owners of my bank accounts. I'm going to put them on the deed to the house. That way, when I'm not here anymore, it'll just transfer to them. Really easy, no problem. Um, Not true. So one thing that people don't realize is number one, when you are adding them on as a an owner of an account or deed to a property, you are giving them a gift. Okay. Remember, CJ said you have this lifetime exclusion credit, but anything over $18,000 in a given year is a gift that needs to be accounted for the remainder of your life. What also happens is they lose the step up in basis, right? Because they received it as a gift. They didn't receive it as a result of death of the owner. So that wiping out of all of the taxable gain doesn't occur. Okay. Lastly, especially as it relates to a house, if somebody owns or adds their kid's name to the deed to their house, and then they sell the house, okay? The child is then potentially liable for capital gains taxes on that property because they do not treat it as their primary residence. They do not live there. Okay. And they are a part owner of it. Okay. All this to say, as much as it feels like, oh gosh, this is really solving problems, this is really creating, just ease later on, please, please, please talk to an attorney, talk to a financial advisor, because these are really easy things that we can avoid on the back end. But they are mistakes we see people make all the time.
Yeah, I really, I really want to jump in here. We call this poor man's estate planning. So it's poor man's because, and by the way, again, I grew up very blue collar. If it's simpler, it's better. And by the way, I generally continue to live by that policy. Simpler is better, except for when it's not. And this would be one of those circumstances where it really is not. Now, I do want to give you one exception. We have no problem if you want to take a $10,000 checking account or $20,000 savings account and list maybe your executor of your will. Maybe it's your oldest child who's in finance or something like that. List them as joint owner of that account just to have, if you die, give them immediate access to some cash to kind of settle things. No problem. The dollar amounts aren't large enough. There's not step up that we're worried about because it's a post-tax bank account anyways. All of that could be fine. As soon as you go beyond that into real property, real estate, investment accounts, and you start listing joint ownership, oh my goodness, do the problems abound. So just want to really echo what Eric said here. As much as I wish the world worked that simply and would allow for it, it doesn't right now. And so, unfortunately, you're going to have to go through the hard work of thinking through a will or a trust, thinking through powers of attorney. Again, 18 different rabbit trails we could go down here, but just know, don't do the poor man's estate planning. It will bite your beneficiaries in the butt or even you later on. And actually, Eric, you didn't even mention one, which is when you list your child as joint owner of your house, if they get into a car accident and get sued, half
Yeah.
your house is liable to that. So even risk and liability protection goes away when you start doing that. So anyway.
So yeah, don't cut corners on this. It's not something you want to, not a part of your life you want to cut corners. All right, so let's put taxes aside for a second. Let's talk about just some kind of behavioral finance or strategies you can use to maximize the impact of the inheritance you receive. So the first one, and I think this is really probably obvious, but using the inheritance to reduce your debt, whether that is a car loan, a credit card, a student loan, these are generally higher interest debts that you want to generally eliminate. And when we're working and we're getting paychecks every 2 weeks, we generally don't get access to a large sum of money like this that allows us to actually wipe out something that is stealing our cash flow every month in the form of a loan payment. Okay. You'll notice I didn't jump on mortgage right away. Mortgages are a little bit more finicky in terms of whether or not we just want to pay them down. Okay. That's really going to come down to number one, how much you owe on your mortgage, what the interest rate is, and whether or not a lump sum is enough to pay off your mortgage. Okay, because remember, we're trying to eliminate things that that steal your cash flow, right? So if you owe $100,000 on your mortgage and you inherit 50,000 and you've cut it in half, awesome, great, but you haven't actually created any excess cash flow for yourself because you still owe $50,000 and you're still required to make the um, the full payment every month until it's paid off. Now you're going to pay it off sooner, which is great, but especially as we're looking at moving towards retirement, because generally when people inherit assets, they are older than we think of ourselves as inheriting assets. We are really looking at what can this do for our cash flow. Funding your emergency reserve. This is another one I think maybe seems obvious, but an emergency reserve, 3 to 6 months of expenses sitting in a savings account that allow you to avoid taking on debt when an emergency happens. Okay, so that whether that's a credit card or having to take out like a home equity loan on your house, whatever it might be, this is a separate separate account for you to be able to draw on as you need in order to avoid taking on debt when things come up. Because we will have things, life happens all the time, right? I talked to a client about that today. Things come up and we need to be ready. But again, the emergency reserve is something that I think as people are working, setting money aside, it's easy to ignore. It's easy to not to avoid building up to where you should. So again, we're getting a lump sum of money allows you to say, okay, I'm going to fully fund that and then focus on other goals. Retirement savings catch up. This is one of my favorites. So as we are looking at inheriting dollars, especially in your pre-retirement years, you can look at it as, well, one of two things. One, you could inherit just after-tax dollars. So you get like a chunk of money, right? That you get a check, it goes into your checking account. That it's not as if we could just take those dollars and put them into a retirement account and say, haha, now I've caught up from everything that, I've caught up and I'm on track to retire now. Because remember, most retirement accounts, with the exception of IRAs, require that you payroll deduct your contribution. Okay, so a little bit comes out each month. You can't just plop a large amount in there at one time. Well, what you can do is say, okay, I inherited, again, let's use the $50,000 number. I inherited $50,000. I would like to use that to catch up on my retirement savings. Great, let's increase the amount that you are withholding from each paycheck. Okay, and then let's put this 50,000 in a separate savings account, and we are going to transfer each month the amount that you are now deferring to your 401k or 403b or whatever it might be, right? So if you go from 5% to 10% or even higher on your 401k deferral, you're obviously getting less at the end of the day from your paycheck, but we're paying ourselves back from that 50,000 that we inherited. Okay, so it's a way for you to put dollars away tax-free. Okay, or Roth. Again, that's a discussion you want to have with your advisor. But you're putting dollars into a tax-preferred account, and in this case, you're drawing dollars from a tax-free source. Okay. The other thing I want to point out here, and I know I'm going long here, but with a pre-tax retirement account that's inherited, remember, we have 10 years to get those dollars out. If you are not maximizing your tax-deferred retirement savings, it's a great way to offset the additional income you have to take on by taking those distributions. Again, by increasing your 401k savings, in this case, tax-deferred, but then taking the distribution you are required to by that pre-tax retirement account. Last one I'm going to talk about here is funding future expenses in advance. So we talk to clients a lot about pre-funding future expenses, whether that's a vacation, maybe that's pre-funding the purchase of a new car so that you don't have to take out a loan when it comes to buying a new car, preparing for future household expenses, maybe you need a roof, whatever it might be. In many cases, we are encouraging folks to set aside a small amount each month to then prepare for these large expenses. Well, again, we're getting a lump sum of money, okay, that is not normally what we get. We get paid, every 2 weeks, for example. but you're getting a lump sum of money that allows you to pre-fund. Okay, so set aside into your new car fund everything that you might need that then allows you to do something different with that monthly contribution that you would have been making. Okay. So there's a lot of different goals here, and some of them work together, some of them don't. So again, prioritizing this with your financial advisor is really, really important. But there are a lot of strategies you can implement, even if there was not a lot of proactive planning done on the front end by whoever you inherited the dollars from. As a reactive beneficiary, you do still have options. You still can be strategic about how you handle these dollars. Anything to add, CJ?
No?
Cool. All right. Last thing. Let's talk about what not to do. Okay. Um, and some of these are obvious, but spending it all, right? This almost seems like an old trope at some point. I think we all like to think of ourselves as pretty responsible and think, oh, if I inherited some money, I wouldn't blow it. You would be surprised how often we see this happen. And unfortunately, without too much proactive planning, there's not often anything that CJ or I can do about it. Even though we may have seen the client, have goals that were not what their child or beneficiary is spending the money on. If the client did not do pre-planning, there's nothing to be done at that point. So spending it all that's definitely a no-no. Not to say you can't spend the assets, but we want to make sure we're being strategic about where you're putting them. Claiming too quickly or too slowly. Okay, so when I say claiming, I mean claiming assets in the inheritance process. So I'm going to talk first about too quickly. CJ touched on this a little bit earlier when he said sometimes people are like, okay, I got a house, I have an investment account, I have an annuity. I don't know, just send me a check for that annuity, right? That'd be an example of not making a plan and spending too quickly, right? I'm overwhelmed. I just need to get this taken care of. Send me a check. Well, you just paid income tax that you maybe didn't need to pay this year. Maybe you could have waited a few years to actually take out the bulk of that money and been more efficient with it from a tax perspective. So when things like this happen, it can be very tempting to just try and get it out of the way as soon as possible. But don't do that at the expense of making smart decisions and being educated about what they mean. And on the too slowly side, this may seem weird because a lot of people will say, well, if somebody's offering, if there's money out there waiting for me, I'm going to go get it. But sometimes people can be really overwhelmed and, life takes over and they don't close the estate or they forget to claim an account or whatever it might be. As CJ said earlier, the state or the custodian that holds the money or whoever it might be, if you don't make a plan, they will make a plan for you. And in many cases, that is receiving a check for the proceeds all at one time, regardless of whether or not they're taxable or not, and whether or not that was what you would want to do from a strategic perspective. So just making sure that number one, we're not making decisions quickly and irresponsibly, but also that we're not avoiding the problem and allowing others to make that decision for us. Telling all of your friends. This is something that I think I think in all of our lives we have people and relationships and some are closer than others. This is not saying you can't lean on other people in these times and ask questions about these things, but there are certain people in your life that don't need to know that you inherited money, right? Because as much as we think that they won't ask you for money or they won't treat you differently as a result of it or try and guilt you into something, these are the realities of living with humans, right? So a certain level of discretion around this goes a long way. We've seen in our experience. Making major life changes immediately. So this often, I think, probably applies more in the case of like losing a spouse, but it can also be, in the case of being a non-spousal beneficiary. Death is obviously an extremely traumatic process. And when people are grieving the loss of a loved one and working through the process of settling their affairs, we really, really encourage people not to make any major life-changing decisions, moving, selling a home, quitting a job, whatever it might be, we encourage people not to make those lifetime decisions for, in many cases, like 12 months, right? Give yourself time to process things, to get an idea of which direction, life is going at that point before you make these huge life altering decisions. The last one here, and in our What Not to Do series, do not try to do this all on your own. I know that sounds self-serving coming from financial advisors, but we have seen this enough times to know that just a little bit of advice along the way goes a really, really long way. And I think that, from the perspective of uh, laws changing around these things, and CJ, you mentioned earlier, we are in the business of doing this. And it's hard sometimes for us to even keep up with the laws of the rules, the regulations that are changing. And so trying to do this while you're also trying to work your day job, take care of your children, live your life, it just makes the process a lot more difficult in our experience. CJ, anything else to add here?
I don't think so. I think what we'll do here, though, at this point, because there's this was the last slide. Yes, Eric?
Yep.
Okay, so everybody, I know we went over time. Apologies, it's 5:15 p.m., but we do really want to prioritize your questions. So one person did already submit a question here that I will read and will answer. But please, at this point, before you kind of click off or log off, go ahead down to the bottom of your screen. There's a Q&A button and type out any questions you have. We'll wait around for a few more minutes to answer them. But the first question that we have in queue is, what are your thoughts on having our parents set up a living trust while they are still alive with us as the beneficiaries? Wonderful question. Wonderful question. It fits right into what we were talking about. So living trusts are also known often as revocable living trusts, revocable in that they can be revoked while the grantor is alive. They, again, why would we establish a trust over a will? Often to try to avoid probate, right? So we're not putting retirement accounts into a revocable trust. We're not putting Roth IRAs into a revocable trust. Typically, what ends up going through the revocable trust would be things like bank accounts, taxable investment accounts, homes, maybe rental properties end up funneling down through this revocable trust. So what are my thoughts about parents establishing a revocable trust and then listing their children as beneficiaries of that revocable trust? My thought is that's what I do. I absolutely. I think that is one of the probably most common plans that our own clients use. They establish revocable trust to avoid probate, to kind of quicken the process of settling the estate upon death, and then they list their children as beneficiaries. Now, that might be outright beneficiaries, or it could be maybe a flip trust gets created for each of the beneficiaries to provide some asset protection and divorce protection, but it doesn't matter. The idea is our thought is fabulous. Revocable living trusts are one of the great estate planning tools that exist out there. Eric, would you add anything to that?
No, that's exactly what I was thinking when they said, what are your thoughts on this? I said, I love this. This is great.
Yes.
This is what
Yes.
we would prefer. Not to say everybody needs to have a trust, but in
Right.
many cases, they can really create a lot of simplicity and make the process as seamless as possible.
Yep. Good. Another question popped in here. So again, everybody, feel free to throw your questions in there. Next question is there any way to protect a trust if a parent ends up in long-term care? I'll hit on this and then Eric, you can fill in my gaps. So revocable living trusts are not tax dodging tools. Let me repeat that. Revocable living trusts don't do much in terms of tax, right? As we talked about, certain account types offer tax benefits, pre-tax, Roth, even taxable accounts have the step-up feature upon death. But often people will say, well, like when I put something in a trust, it gets all the tax benefits. And Eric and I look at them and go, what tax benefits do you speak of? Now, that is a revocable living trust, completely different than things like what are called GRUTs and GRATs, which are grantor retained annuity trust and charitable remainder annuity trust, and even irrevocable life insurance trust. Those are a whole different seminar that we could do another day. We're not going to talk about that today. Revocable living trusts, which are the most common form of trust that we see, don't provide tax benefit necessarily during or even after life. Now, they expedite the settlement process. You do avoid probate, and it's faster often. But don't think of revocable living trust through the standpoint of tax benefits. Now, why do I say that? Because therefore, a revocable living trust does not offer protection against a Medicaid spend down. So what you're referencing is protection against a nursing home. If the nursing home says you need to private pay for until you get down to a certain minimum threshold before Medicaid will kick on, well, assets in the revocable trust would be counted towards that spend down. Now, what you might be asking, this individual who's asking the question, might be asking a more nuanced question. The question might be, I've heard that there are certain types of trust that can help to protect. There are. So there are what are called Medicaid trusts that actually avoid the Medicaid spend down, but they do live in the world of what we call irrevocability. Okay. So a Medicaid spend down trust or just an outright irrevocable trust, these are trusts that are irrevocable in nature, which anything that's irrevocable, you better slow down and ask a lot of questions. So what we would say is, yes, there is a world in which you can do this. I just met mid last week with an individual that had one of these. They put majority of their assets into a Medicaid spend down protected trust so that if they go into a nursing home, their personal assets get depleted very quickly. But there's 5-year lookbacks and all kinds of things you want to be cautious of here. Not to mention, you don't own the money anymore. So if suddenly you want it back later on, there's consequences. So I said I was going to be brief, but I wasn't brief. Eric, any other thoughts about that?
The only thing I'd add here is what you're doing in the case of a Medicaid spend down trust or an irrevocable trust, right, is essentially removing, in many cases, your ownership of assets and putting it into a separate entity, right? That's what an irrevocable trust can offer beside or compared to a revocable trust. But what is really going on in this case is you are attempting to remove assets from your estate to basically impoverish yourself to such a point that the state will step in the form of Medicaid and pay for example, a nursing home, right?
And let me jump in. When we say the state, remember, state governments and federal governments don't generate revenue. Taxpayers, right? Now, the state is carrying this out. So I'm thankful that the state has governance that carries that out, but taxpayers are funding this. So to Eric's point, yes, you are making yourself look impoverished faster so that taxpayers can fund your care. Okay, sorry, Eric, keep going.
And what that does is separate from any other issue, it removes flexibility, right? It puts you at a point where you need to find a facility that accepts Medicaid, right? Because that's not something that many of these facilities want to do in some cases because they maybe don't get reimbursed as much by Medicaid. Or you may need to private pay for a number of years before you even qualify with that facility to live there and be on Medicaid. So it's not like a get out of jail free card, right? Oh, just put the dollars in the irrevocable trust and you're home free. You are sacrificing some things, right? Independence, the ability to make kind of your own decisions around where you want to live, and you are putting yourself essentially uh, in a position where the welfare system then is taking care of
And the quality of the facility. I can tell you that there's all kinds of rules and restrictions around this as it relates to once you've been in a facility for a certain period of time, they have to have a certain number of Medicaid beds available to people who do run out of money. But often the quality of the bed that you get on Medicaid is not going to be the quality of the bed that you do otherwise. So I can tell you if any one of us went into business together to establish a long-term care facility to try to care for the seniors in our community, taking in a bunch of Medicaid patients would be a quick way to go out of business. And therefore, you just have to understand that this is what facilities are trying to avoid. It's often why they put you through financial rigor on the way in to make sure that you can private pay for a long enough period of time. So great question on kind of revocable and irrevocable trusts, trying to avoid the Medicaid spend down. There's a lot to be discussed there, and that's certainly something you want to talk with your financial advisor about. But listen, friends, it is 5:25 and we have kept you way over time. Eric and I love this stuff. I hope you sense the passion that we have in it. We think we are privileged to work in one of the best industries on the face of the earth, and we mean that sincerely. We love getting to work with people to help them think strategically about their finances so that the stress level they experience can go way down. And we just bring a lot of passion to this topic. Thank you to everyone for participating. As we said, this is being recorded. We'll try to post this to our website and send you a link so that you can share it with friends as you see fit. But also keep a lookout for any additional Klaas U webinars that we throw out. We try to do one about once a quarter. So thank you everybody for participating, and we'll see you again soon.
Thanks, guys.
Bye.